Vetri Subramaniam joins us, Group President and Head of Equity with UTI Asset Management. Vetri, morning. Thank you for joining us. Vetri, what is your sense? I mean, do you think we are nearing the pain for 2018, or we should not get carried away with one day of global strength and with one day of smart rally in the bond market? What is your sense? Do you think the pain is behind us, or more, or there's more to come?
Well, I think you could have that debate, every single day, and there's no way to know that beforehand. So I won't get into that too much. But I think as far as bonds are concerned, I think there was a lot of chatter in the market about, concerns about higher yields and the impact of the borrowing program. So I think the good news is that the government seems to have reacted to the chatter in the market and, has come out with a bond borrowing program which has assuaged some of the nerves there. So that is certainly a good sign. And to the extent that, India's growth cycle requires interest rates to sort of not come under undue pressure on account of the fiscal deficit or the government's borrowing program, that also I believe is eventually good news for equities. But I think the bigger picture remains that valuations in Indian equities had moved up quite a bit, and if you look at the valuations in early to late January, they were almost on the Nifty at 25 times trailing earnings, which by no stretch of imagination is cheap. If anything, it's pricey. We've now seen a 10% correction come through. Earnings are up over the last 6 months by about 7-8%. So there's been a little bit of a valuation correction. As fund managers, the good news, and we are thankful for that, we are finding some more ideas that we can buy into thanks to this correction. But it's still not a really cheap market. So I think it's going to remain tricky territory at this point of time, simply because of where we are as far as valuations are concerned.
Vetri, there were two concerns in the world. One, what will happen to liquidity because of central bank action, and B, could we be staring at a trade war? Are you getting a sense that both those global concerns are getting addressed one by one?
I'm not sure that those are the only two concerns. I'm sure if you did a poll, Nikunj, you would find that there are far more concerns globally or locally. But point being that, I think as far as the removal of liquidity is concerned, that was something which has been telegraphed, but it is a reality now that we've not only got the US Fed, which has already embarked on removal of liquidity by a reversal of QE, but we've also clearly got Europe saying that they will follow suit during this year, and we even had Japan, who's pretty late to the party, saying that in 2019 it would be appropriate for them to step back. So I think, yes, certainly this is something that all the global markets will have to deal with, and more so the bond markets will have to deal with this reversal of liquidity. But anything nasty that happens in the bond market has a flow through to equities, so it's something we should certainly be aware of. But again, to my mind, it all comes down to valuations. It's easier to handle bad news when valuations are cheap. It's more difficult to handle a transition when valuations are expensive. So I think that's something we need to keep in mind. I think particularly on the trade war front, war is a very big word, and I don't think we should use that lightly. Clearly there is some sort of a battle underway at this point of time, and counter punches being thrown pretty much across the world with everybody responding. It's something to keep on your radar, because it's a reversal of the trend of globalization that we've taken for granted for a very, very long period of time. But I don't think we have enough evidence at this point of time to believe that we are on the verge of a massive and a nasty trade war. And if that were the case, I think that would certainly be negative for equities. There's no other way to put it. But I think we just need to wait and watch, because at this point of time it looks more like just light punches being thrown. But as a father of two, I do know that when you have two people throwing punches at each other, things could always escalate out of hand.
Seems like there's been a fresh incident of that one, Vetri. Good to speak with you. Morning. Just wanted to discuss about PSU banks, though, on the other hand. They were dealing with a situation of excess SLR. Now, with the government borrowing program being announced for H1, things would definitely ease a bit. But does that give you conviction to go out and buy PSU banks, because they have corrected quite a fair bit?
A good question. I think if you just step back for a moment, the challenge in looking at any of these lenders, and most of these lenders, if we step away from the private PSU conundrum, it's really a challenge that's being faced by the corporate sector lenders, right? The non-corporate sector lenders are, continuing to grow. They don't seem to have any trouble. So the problem really comes down to those who've been lending to the corporate sector. I think as far as this group of institutions is concerned, and they are both in the private as well as the public sector, I think we are closer to the end of the recognition cycle of NPAs. We are close to the peak in terms of credit costs being taken into account on the P&L, and therefore the P&L might look very weak, but the flow of stressed assets is actually starting to come off quite a bit. So I think we are closer to the end over there. But when you look at all these corporate lenders, the two things that matter to me the most is the quality of the liability franchise and the ability of the institution, both given if it has a healthy capital adequacy ratio, and the ability for it to grow its assets based on that strong liquidity liability franchise that it has. Now when you look at these parameters, we find that it's some of the private corporate sector lenders which tend to come out much better, because they've got healthy capital adequacy ratios. The liability structure is strong. In fact, it's become stronger over the last 3 to 4 years when they've had asset side issues, and we think they're pretty well placed for the next growth cycle. So our preference would be predominantly more towards private corporate sector lenders, but there are 1 or 2 public sector banks as well that we would look at. I think the other thing to keep in mind here is that we just have too many public sector lenders, and I think as investors we now need to get more and more choosy. There may have been a time where all 21 public sector banks were on an investor's radar. I think now that choice set has drilled down to maybe 2, 3, 4, 5 banks, depending on what kind of investor you're talking to, and I think selectivity really is the name of the game over there.
It's interesting, Vetri, that I'm just going through your notes, and you do believe that when it comes to pharma, seems like the healing process is very much underway, and you believe that there are some individual pockets of attractive valuations where all the US FDA issues and the Form 483s and the observations, etc., the risk is behind us. Where do you find value within pharma?
Yeah, I'm just going to nitpick on that. I'm not sure about risk being behind us. I just think the risk is in the price. There could be some more risks over there as well. But no, I think the key issue here is you've seen a sector which, was a darling of the market. It had seen a massive upward re-rating, and now you're seeing pretty much the opposite. I'm inclined to believe that, when everybody is fleeing the area, even the good gets trashed along with the poor. And therefore, it's more likely that, if you go into that area today, you will find some names which are attractive. They've got solid business models. They may be challenged for growth in the short to near term, but that's, the fundamentals of the balance sheet, the business model are intact. The return on capital, we think, is still something which is attractive. So we are attracted to some of those business models. And keep in mind in pharma that in the Indian business still has very, very robust fundamentals, both in terms of growth as well as in terms of profitability and return on capital. And depending on the pharma company you look at, anywhere between 30 to 70% or even 100% of the profits actually come from that domestic market that they have. And I think that remains a very attractive business because of what I described earlier. It's profitable, it's high ROE, and I would actually argue that some of the fundamentals in that area actually resemble what you typically see in the FMCG space. So I think all the names are getting tarred with the same brush, but some are superior, some will come back stronger at the end of the cycle. And I'm more inclined to look for opportunities there rather than to flee from that territory at this point of time, because I think a lot of the bad news, a lot of the risks are now built into the stock prices.
But Vetri, given what's happening to PSU banks, the fact that high frequency data points are still mixed, do you think one should once again hunker down earning expectations, and we should not bet on a very sharp and a smart cyclical recovery in the second half of this year? Because Vetri, time and again when we start the year with assumptions of double-digit growth, and it's only by middle of the year we realize that okay, we've gone wrong in our earning assessment, it's time to hunker them down. Do you think this year will be no different? Well,
I'm sure we'll get at some point to a year which turns out to be different, but the implied growth rate for 2019 has gone up dramatically, because I think what's happened is that analysts have cut all the estimates for the year ended March 2018, which will be done sometime this week, but they haven't really cut their forecast for 2019. And if you look at the sharp increase in profits, which is forecast for 19, anywhere between 25 to 28%, a lot of that, I would argue, is actually just a sort of reversion to mean, where there are some institutions who've suffered dramatically in terms of profitability in 18, and a normalization in 2019 is causing that big swing. So point number one, don't get carried away with that 27 or 28% consensus earnings forecast at this point of time. Not only has it proved to be misleading in the past, even if it comes through, I think the quality of that growth number is actually a bit suspect. If you look at the growth oriented companies, I suspect that their growth rate may actually be slightly lower than that number. The swing is coming from companies that had losses in 18. I think the bigger issue over here as far as earnings is concerned is that I think clearly the economy is showing a little bit of a cyclical improvement that's visible in all the high frequency indicators. But we've seen this period again in 14-15, where we had this period of 1 to 2 years of increase in growth rates, and then everything started to cool off again. So we don't know how much of it is cyclical, how much of it is structural. I think the two areas that I would continue to look at, which hold the key to seeing a more sustainable improvement in GDP growth rates and eventually in earnings, one is clearly exports, and the second is the capital investment cycle. I think these two remain the key to something being sustainable as far as the economic growth numbers are concerned, and also eventually as far as earnings are concerned.
And Vetri, on the consumption side, some of the consumption stocks are trading at P multiples which could be called as rather lofty, whether it is an HUL or whether it is a Dabur. But if I look at the data which has come out for the volume growth, and I'm keeping the demonetization base effect aside, the data is looking impressive. So is there a case to justify these P multiples, what some of the consumer staples and some of these brand companies are enjoying?
Given the perspective that I have and my sort of style, as I told you, I prefer to look at areas which are sort of being distressed and ignored. And if I look at the consumer sector, I think they've gone through a massive period of re-rating. If you go back to 2009, 2010, you could have bought these companies at multiples which are anywhere between a half of their current multiples to maybe 2/3 of their current multiples. So I think there's been a massive re-rating over there. And while there could be few names which still look okay, it's not an area that I'm particularly excited about. I think there are without doubt high quality companies, but at these valuations I'm not sure how much you can really extract from them in terms of returns from these levels. I also think that once we enter and if we do, as and when we do enter an environment where the confidence in growth rate and the underlying economic cycle, the exports, the capital investment and the underlying growth rate starts to pick up, you will most probably see some rebalancing away from the high premium that people have been willing to pay for these businesses simply because they were able to deliver growth through a very, very challenging period for the economy. So I think just from a valuation perspective, I find the consumer area honestly a little bit vulnerable, and I think as confidence in other parts of the market increases, these valuations will prove to be a drag on returns. Not to do with the fundamentals of the companies, but these valuations just set the bar way too high for my comfort.
So, Vetri, what are pockets best avoided? Most brokerages are now coming out with notes saying that, irrespective of US extending that olive branch towards China, you don't really know things which are, how things are going to really materialize or pan out from here. So there are those pockets, companies and sectors which have interlinkage to US and exports, Tata Motors or a Bharat Forge or a Motherson Sumi, etc., which are stories which could be avoided. Do you have a list like that which you're working with?
No, Not really, because these themes come and go, and I've been in the market for 25 years, and every 6 months something or the other comes to the forefront in terms of being the risk that everybody most worries about. But I don't think that's the best way to go about investing. So if I were to have a list, and I do have a list of companies that I would like to avoid, I don't think they flow from these themes. They would either be a subset of what I talked about earlier, which is valuations, or they would be essentially companies where the balance sheets are weak, the cash flows are weak, and their ability to grow through the next economic cycle is actually a little bit of a question mark. So if I have an avoid list, it would have to do an avoid list more to do with valuations, more to do with poor quality of balance sheets and cash flows, rather than to do with these themes. I mean, 6 months ago we weren't discussing trade war, right? And today that seems to be at the top of the mind. But these things come and go. If we had had a conversation in the first quarter of 2016, metals was a complete no-go area because everybody was panicked about China slowing down, and then look what's happened to metals after that. So I tend not to get driven too much by what is the most popular issue getting debated either in news channels or by newspapers. I think if you just look at valuations and quality of the business, I think those two are better determinants of where you want to be and equally where you don't want to be.
Okay, fair point. Vetri, good speaking with you. Thanks much for taking the time out and chatting with us today.